Yeah. Uh, Hi guys. Good morning. Today we will begin to start with one new topic with IS2 inventories. So before I proceed to what's IS2 inventories, I would like to give some brief introduction about myself. Uh, my name is Jaiswal, and I'm currently pursuing ACCA. I'm done with 12 papers out of 13. So I'm currently working at KNAV in US assurance team. Okay, so so this is an so we are discussing the SBR, which is basically called as SBR, SBR, SBR subject, and we are discussing IS2 inventories. Yeah, so so uh, so it doesn't mean like if I'm covering SBR, it doesn't mean like it should only watched by SBR student. Uh, can also referred by F7 student, which is financial reporting, as well as F3 student, which is financial accounting student as well. Okay, so here we are covering with IS2 inventories. Okay, so okay, yeah, one more thing. While discussing with this high standard, I will take an example of say one mango juice manufacturer. Okay, one mango juice manufacturer. I think this is a good one, like now to understand this standard. Okay. So yeah, so there is a so inventories. Okay, inventories. So basically there was three types of inventories. Okay, the first is the raw material. The second is the work in progress, and the third is finished goods. So I'm assuming that you guys are aware about this terminology of these three inventories that I have mentioned. Okay, so so at the beginning, so let first we discuss the initial measurement, then we will cover the subsequent measurement. Okay, so okay, and one more thing, like normally what I do now, like what I do when I'm studying it now, so I'm not don't go through with each and every line and each and every word, but basically I'm then when I'm studying for SBR, so yeah, so so you can see that there is a 800 pages. Okay, this book has a 800 pages. So I cannot remember the 800 pages, each and every word with each and every line. Okay. So what normally I do now, so I normally highlight those words or text that can help me to get to remember the all to get to give me an overview of of accounting standard. To give me an overview. Okay, because I'm not an Einstein, so that I can remember the 800 pages. Sorry. So I generally highlight these keywords or key lines that accounting standard have in order to get me an idea about what what it is and how it is. Okay. So yeah, inventories. So inventories, the initial measurement of inventories. So inventories are initially measured at cost. Okay. Okay. Inventories are initially measured at cost. Say for example, if we are a mango juice manufacturer. Okay. Okay. So if we have order, so we are a mango juice manufacturer. Okay. So what raw material we will be needed? Which is a key raw material that we will be needed? First is mango. Okay. So mango. So say mango. Okay. So the day, for example, today is 9 July. Okay. So let's say I order uh, 12 dozen mango. Okay. For in order to proceed tomorrow. Okay, to make a juice. Okay, so when I order today, 9 July, so I hope it will be delivered on tomorrow morning, I guess. Okay, tomorrow morning on 10th of July. So when the order will be delivered at my place, at that time I will record this inventory at a cost. Okay, and this is basically what this the cost, and this cost comprise of what? This comprise of purchase price less discounts and rebates whatever I receive, and as well as import duties if I am paying, or taxes, as well as transport and handling cost if I am incurring this. Okay, if the supplier, like whoever is supplying me, is incurring, then it is automatically included in the purchase price, so there is no issue, not an issue. Okay, so if we are incurring this cost, import duties, recoverable taxes, transport and handling cost, so we have to include it at when we are measuring at cost. Yeah, yeah. Then and then we have a conversion cost. Conversion cost is basically for conversion cost is for work in progress or finished goods. It's mostly applied to those goods, those inventories. Okay, because the raw material that we have received, mango, we have not incurred any, we have not converted into any, we have not done any manufacturing on those, so we cannot apply conversion cost. Okay, so yeah, I have work in progress and finished goods. Okay, so if you have bring the inventory, we have started manufacturing it. Okay, so once we manufacture in the inventories, like for example, we have ordered the juice and then we have manufactured and proceeded and we get a juice. Finally, we got the end output, which is mango juice. Okay, so then at that time I have to value it. Okay, value it. So I have to value it, right? So so conversion, I have to value it. So what we have to measure it. So in order to measure it, like if you have do a manufacturing and now we have to measure it. So what we have to measure it, have to measure it at a lower of cost and NRV. NRV. Okay. So NRV, what do you mean cost? As we have already discussed about what is the cost. Yeah. Cost is basically comprised of purchase cost and the conversion cost. Okay. And then we have a NRV. NRV. What is an NRV? So NRV is basically as NRV is a estimated proceed from selling the inventory less completion and selling cost. Okay, so if you have, for example, if you have manufactured the product. Okay, we have manufactured the fruit juice and now we have to value it because we have to value it. So we have to value it over of cost and RA. So whichever the cost, like for example, cost is purchase price. So purchase price include my purchase cost of the raw material, which is my mango. Okay, and second, the conversion cost, whatever the cost I have incurred on in order to convert into a juice. So for example, I've incurred a material, I've incurred a labor, I've incurred any fixed or variable production overhead. Okay, so that will be a conversion cost. So so cost comprise purchase cost and conversion cost. Okay, okay. So this is my cost, and then we have a NRV. NRV is basically the proceed that will be received. For example, we have manufactured this juice, and now if we go to sell it, for example, we receive 100 rupees. Okay, for example, if we receive 100 rupees. Okay, okay, I will discuss with you some proper examples for you. I will better understand. Yeah, just a second. Yeah, so we have a purchase price. We have purchased a raw material for 100. Okay, and in order to convert them into end juice and output output, which is basically a mango juice, mango mango juice. In order to convert it to end output, we have to do some manufacturing. So a manufacturing cost, which is basically a conversion cost. Okay. Conversion cost. So we have incurred a conversion cost of say 50 rupees. Okay. So what is my end output value? This plus this. I'm assuming we have not incurred any loss while manufacturing. Okay. Okay. Just a second. Give me just a second. So where we are, guys? We are at, okay. So we have incurred a purchase price of 100, and then we have converted into, we have manufactured it. Okay. So manufacturing cost, we have incurred 50 rupees. Say we have used our labor in order to convert into user. So the end output value will be 150. Okay. And second thing, the note that I have to write over here is that we have not we have not incurred any normal or abnormal losses. Okay, assuming we have not incurred any normal amount. So this is what my cost. This is what my cost. Okay. What is NRV? NRV. Okay. So wait. So NRV. So NRV is a estimated proceed from selling the inventory less completion and selling cost. Okay. Completion and selling cost less completion and selling cost. So for example, if I go to market, not go to market, if I go to market in order to sell my fruit juice, I able to sell it at a cost of say 300. Okay, sell a cost of, but in order to sell it, I have to incur a selling cost, sorry, completion cost. Okay, completion. If you incur a completion cost, yeah, I have to incur completion cost. So we have an output cost of 150. We have an NRV if I sell it at a 300, but we have to incur a completion cost. Uh, just say completion, what completion cost can be incurred? Okay. Say we have incurred a completion cost of 50 rupees. Okay, and then completion cost we incurred, and then we have incur a selling cost of 90 rupees. Okay, so what will be my end valuation? Will be 160. Okay, 160. So this is my NRV, selling proceed. Proceed. Okay, this is my selling proceed and this is my NRV. So if I want to value this inventory for this finished good, if I want to value this finished good subsequently, I have to value it lower of cost and NRV. So what value do I get? Lower of cost and NRV. So which is my lower value? NRV is my 116 and output value is the 150. So at the end, we have a lower value of 150. So this is my, I value my finished good at this value, which is basically 150. Okay. Yeah. Yeah. Next. Okay. Okay. So we have a disclosure. We have like IAS 2 inventories also requires some of the disclosure that should be made. Okay. So entities should disclose the total carrying amount of inventory by category. Because as we have discussed, as I have discussed, like there are three types of inventory. The raw, again I'm repeating, the raw material, work in progress, and finished goods. Okay. So we have to classify this inventory and value and also classify inventory into this three category, and we have to disclose that individual carrying amount. Okay. And second, what we have to make a disclosure is disclosure of inventory carried at net realizable value. Okay. So in our example, we don't have NRV. Don't value this inventory at NRV, so we don't have to disclose it because we have already valued the cost. So there's no need to. But if we have a NRV, which is one, if for say NRV should be a 140, so I will be valuing this inventory at 140. Okay, and then I have to disclose this this as a this, and then I have to disclose this NRV in my disclosure note. Okay, yeah, yeah. And so we have done. Let's take in one example in order to help you a better understanding. Say illustration one, valuation of inventory. So an entity has a falling item of inventory. Raw material costing 12,000. Brought it for processing and assembly for a profitable special order. Since buying this item, the cost price of the raw material has fallen to 10,000. Okay, fallen to 10,000, brought it to 12,000. We have brought it this inventory. Say we have brought it mangoes, 12 dozen mangoes. We have brought it 12 dozen mangoes at the cost of 12,000. But on the next day, there is on the next day that when the order was delivered, on the night of the day the order was delivered, there was a heavy rain, and this could lead to our mango. Some of our mango will become damaged or destroyed. Okay, and then the 12 dozen value, the 12 if we sell this 12 dozen mango without processing it, without processing it, without processing it, if I sell this 12 dozen mango to someone else, so how much I expected to receive? 12,000, sorry, 10,000, 10,000. So when I'm valuing this inventory, what 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 we have to think, what we have to think, we have to think about this, the subsequent measurement, because we are subsequent valuing it subsequently, right? We have obtained it. We have initially purchased it at a 12,000. Then when we are recognizing in our records, our books of account, we record it at a 12,000, because it is the initial measurement, which is here we have learned the inventory are initially measured at cost. Okay, but subsequently the next day the rainy season has rain, because of the rainy season that we have a damage of our mango. So we have to value it again subsequently. So subsequently we have to value it lower of cost and NRV. Okay, so lower of cost, so which is lower? 12,000 is my cost, and my NRV will be 10,000, because if I sell it, then the value of we expected to receive is 10,000 only. So we have to wear. So what is my lower of cost and NRV? This NRV is lower than the cost. So we have valued this inventory at a $10,000. Okay. Yeah. Let's check in second example. For example, if equipment constructed for a customer at an agreed price of 18,000, say one customer, say let's take an same example. We don't want to discuss it with another, so in order to make it complicated, let's say we received one party order from one of the our client for mango juice, which is for at a agreed for a say 100 glass of mango juice we will be delivering to them at a cost of 18,000. Okay, then recently, then after the completion, then after the completed, then but we have at an agreed price of 18,000, but we have completed this inventory, but we are manufacturing this 100 glass at a cost of 1,600. Okay, this is our agreed price, this is our sale price, and in the cost we have incurred in order to manufacture this 100 glass of mango juice is 16,800. Okay, okay, but it has now been discovered that in order to meet certain regulation, conversion with an extra of 4,200 will be required. But but the client, but the say, but the what we instead of saying, we can say uh, okay. Let's check the customer has later informed us that we need some extra flavor in this. We need some extra flavor in our 100 glass of mango juice. So what we have communicated with our customer that what we have communicated with our customer is that in order to get an extra flavor, I have to incur the 4,200 rupees. But we suffer this 400,200 equally. Okay, in order to include this extra flavor, we have to, there is an extra cost which is 4,200, but we will suffer, the client and us will suffer it equally. Okay, so 4,200, so 2,200 will be suffered by the client and 2,200 will be suffered by us. Okay, so will we require the customer was, okay. Yeah, or we can, or we can this, I think this example, like whatever the example I'm discussing on Michael is not apply over here. I think we have to go with this simple example only. We will do this example only. Okay, so this is for a, this for this example we should stop assuming ourselves as a mango juice manufacturer. We have to think like we have to think something else. Okay, so let's, okay, now again, the equipment constructed for a customer at an agreed price of 18,000. Okay, so we have received one order from our customer that he want some equipment, he wants some equipment to be constructed at a cost, at the agreed price of 18,000. The sales price at 18,000 means we, the sales price of 18,000, but and we have manufactured that equipment at a cost 16,800. Okay, 16,800. It has now been discovered that in order to meet certain regulation, conversion with an extra cost of 4,002 will be required. So we have manufactured one equipment, but later we have identified, later because of the some regulation has been changed, or regulation has been changed. So the government will require, oh, sorry, the regulator will be required the, the certain more condition to be fulfilled in order for manufacture this equipment. And in order to meet this condition, we have incurred extra cost of 4,200. But the customer has accepted the partial responsibility and agreed to meet half of the extra cost. The customer has accepted the partial responsibility and agree to meet half of the extra cost. Half. Yeah. So what our cost is 16,800. Okay. And what our cost is 16,800. And then later we have later we get to know that we have to incur extra 4,200 in order to sell it. Means in order to sell it. Okay, as what this is what regulator require. But the customer has told us that you are like, say, Prince, you don't want to incur the 4,200 full in full amount. I will suffer 2,000, half 50%, which is basically 2,100. Okay, so now, so now, now what we have to do is valuation. What in accord, how do we do valuation in accordance with IAS to inventories, in accordance with IAS to inventories. Okay, so what IAS to inventories require? So in my IAS to inventory required subsequently. We are discussing subsequently, we are not initially. Okay, we are discussing here subsequently. We have already manufactured. We have done. We have manufactured the equipment, and so now we are valuing subsequently. So IS2 again, I'm repeating, it require the value. It required that inventory should be valued at lower of cost and NRV. Okay, so let's take an example. So I will explain with you in an Excel, so it will be better for you. So 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 okay. So let's take another sheet. So our sales price is $18,000. Okay, and what our cost is to manufacture it is 16,800. 16,800. Okay, but the extra cost, we have to incur this extra cost of 4,200, but the customer has spread a partial responsibility. So ultimately, what the extra cost that we have to incur is 2,100 only. So extra cost, so 4,200 divided by 2, extra cost will be this. Okay. So, okay. So now we have to value it at a lower of cost and NRV. So what is my cost? Lower of cost NRV. So what is my cost? My cost is 16,800. Okay. And what is my NRV? NRV is what? NRV is what? Again, I'm repeating. What is NRV? NRV is the estimated proceed from selling the inventory less completion and selling cost. So what is NRV? The estimated proceed from selling the inventory less cost of completion and selling cost. So what is my proceed? Is my proceed is 18,000. Okay, my proceed is 18,000, and in order to do this, in order to sell it, I have to incur the extra 2,100. Okay, I have to incur this extra 2,100. So extra 2,100. So what is my net NRE? 18,000 minus 2,100, which is come to at 15,900. Okay. So now I have to value it lower of cost and so this is what is my NRV. So what is my lower cost or NRV? So my lower is NRV, which is this value, which is this value. Okay. So my lower is my NRV. Okay. So I will value this inventory in accordance with IAS. In accordance with IAS to inventory, I will value this inventory at 15,900. Okay. Yeah. Even let's check an answer. Okay, so the net realizable value is 5,900, and the net residual value is below. Net residual value is below the cost price. Last same what we have done. The net residual value is below the cost. 5,900 is less than 16,800, and therefore the inventory should be held at 5,900, and we are valuing it and at 5,900 only. So our answer is correct. Yeah. So, and one more thing I want to know, one more thing I have to highlight it is that IS, yeah. So IS2 inventories, IS, one more thing I have, like I forgot to discuss with you. I should be discussing it in the beginning only, but okay, no worries. So IS2 allow three methods for arriving at the cost of inventories. The first is actual units cost. The first in first out, which is the second method, and the third is actual weighted average cost. Okay. So actual unit cost. Actual unit cost, for example, say in this example, we have incurred a cost of 1,600. Okay, in order to manufacture this equipment, and I can see that this is a special order. I guess. Agreed cost is not okay. Okay, so this is a special order. So this is the first example having special order. So we have incurred, so we have to value this inventory at actual unit cost. So we will value that 10,000 only. Yeah. Yeah, actual unit cost. And then we will discuss first in, first out. Okay. And the third method is weighted average cost. Okay. So we will discuss the three methods in our later videos. Okay. So till now, this is sufficient, and we will come with this inventory valuation, this three method of arriving the cost of inventories in our later video. Okay. So this is so done, guys. I think we have covered a lot for in order to discuss this IS2 inventories. Okay. So yeah, guys. Yeah. Bye.